Hello and welcome to the stock specific class here for Thursday, June the 29th. As always, if you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to jerry@traderspro.com. Also, a quick announcement for Monday. Just be aware that Monday is going to be a half trading day. Obviously, the market's going to be closed on Tuesday for the 4th of July holiday. We will not have class on Tuesday, which means that our next class will be next Thursday. We'll have a stock-specific class next Thursday. But be aware that Monday is a half trading day. Market closes at 1 p.m. Eastern Time. That's 12 p.m. Central Time, 11 a.m. Mountain Time, 10 a.m. Pacific Time. So basically 3 hours earlier than normal is when it closes. Now, that it's not as critical. Usually it's not as critical that you know that when there's a half trading day during the week or earlier in the week. Where it becomes a problem is when you have those half trading days on Fridays, because especially with all the weekly option expirations, if you trade options and you think the market's closing at a normal time and it closed 3 hours earlier and you were planning on getting out of a position that day, that's where it can be kind of shocking. I've had that happen a couple times, a long time ago, but I had it happen before, and it was not a fun thing. Actually, it happened it was before weekly options were even available. It was just the regular monthly expiration, but it just happened to line up, and I wasn't paying attention to it. And so I try to, in these updates, I try to warn you when there's a holiday coming up or when there's a half trading day coming up, just so that hopefully it doesn't happen to you. But just be aware of that schedule next week. Now, as far as the direction alerts, and not much has changed since Tuesday. We're not stretched in any fashion. Momentum's kind of right in the middle. Breadth is right in the middle. And again, that's all we're really focusing on with these direction alerts, is are we getting to the extreme range one way or the other, overbought or oversold. Now, I did notice that sentiment was down here, but this is there must be a data problem on this, because we've been at the far right side of extreme, and sentiment has not come down this far in the last day, because it was on the extreme yesterday. So there must be a little bit of a data glitch there. That happens sometimes in any service. Hopefully that gets corrected here pretty soon. But it's not very critical on this one, because we already know how extreme that sentiment has been, and so and we know that's not going to alleviate that quickly without a major market sell-off in some way. Buy-sell ratios are compact. Looks like the buys might be looking to pass the sells here, but we're not stretched in any way as far as extreme. Usually you're looking for widening out like this. These are extreme ranges. So this is where the buys were outpacing the sells. Here the sells were outpacing the buys, but they got a little bit stretched. Why is that important to recognize? Well, because when it gets stretched, it tends to move back in the other direction. And that's why after it gets real extreme here, it tends to work its way back. This was one of the longest flat consolidated periods I've ever seen. That was earlier in the year, where we had to suffer through April and May, where the market didn't do anything. It just actually it was March and April that it just went completely sideways. But that tells us too that usually when you're in a condensed period like that, you're more likely to move towards one of these periods where it starts to stretch out. And typically in this context that we've been looking at we would assume to be, with the market being a little bit overbought in the longer term, we would assume that means a pullback, causing that to widen out those things, just so the sales outpace the buys in that context there. Our other sentiment indicator is, again, kind of in no man's land, not showing any sort of extreme range. We do want to pay attention if it gets back up into this area here. And that's why if the market does break out of that area I mentioned on Tuesday, we'll look at that again here today. Then it's probably going to quickly go back to that overbought, the extreme overbought, where we're again expecting a pullback. So sometimes these topping patterns can last a little bit longer before they correct. But it's an area here. The biggest thing is it's an area here on the chart where you don't want to be overly aggressive. You don't want to be just piling in right here. You want to kind of wait until you get that next pullback. The longer term charts, like I said, have tended to turn a little bit more bullish. We'll look at that. We look at the SPY chart. It's just we need to alleviate that longer term overbought condition. And again, we'll look at that when we pull up the charts again here. But it wouldn't take much to get right back to that extreme, and that's why even if the market breaks out, it would probably be short-lived. You'll probably start seeing bearish reversal candles again. We're seeing a lot of it. A good example of this is, and we'll try to take a look at this too, is those mega cap tech stocks. They're not completely rolling over yet, but they're starting to show all the signs of slowing the rally and starting to show weakness and possibly rolling over. And again, it doesn't mean they have to drop right here. Even if they do try to push higher, what you would probably see immediately is another bearish reversal showing that buying exhaustion, and maybe the sellers getting a little bit more confident. A good example of this is that chart of NVIDIA. You really start to see NVIDIA kind of roll over a little bit, and it would be understandable with the move it's been on and the valuation now that it has pretty extreme. All right, let's take a look at the chart. And I want to immediately go on to my other charting service, because what we were looking at on Tuesday, I mentioned that weekly candle. We had that bearish inside week last week. And what we're really focusing on is this candle from the week before, because this is what we're inside of right here. If we break below the body of that candle, that's why the red line right here, that would confirm that bearish inside candle. And again, this isn't predicting a massive drop or anything. We're just looking at maybe a kind of an ABC pullback. Again, you can note here on this chart how when I talk about long-term overbought, this is a weekly chart, so this is the 200-week moving average, but look how far away we are from that. Typically, when we get that far away, there tends to be that mean reversion where we come back to it. And that's both directions. You can see an example of this on the way down, that when we got too far, when you get too far below or down, I don't have the 200 on here. This is the 200 week. I'd have to switch over to the 200 day, but if it gets too far, if we just use a 20-week moving average right here, it gets too far away from it here, it tends to move back towards it. In this case, when it gets too far above it, it tends to come back. And so, again, this is not a perfect predictor. You're definitely not going to base a trade on that alone and say, oh, I better be shorting the market right here. But if you start to see it stretch like that, and then you start to see bearish reversal candles, or bearish inside day, what we're looking at right now, again, if you're looking for something that tells you exactly what's going to happen next, hopefully by now you've learned you got to throw that belief out the window. There's nothing that will tell you exactly what's going to happen next. And sometimes these things, particularly with these candles, sometimes you see them work enough times to where you start to think that they're perfectly going to predict a move, but you'll get burned. You do it. You trade those long enough, you're going to get burned on a few of them. That'll remind you that you can't know for sure and that they aren't perfectly predicting a move. And then after a while, after you get beat up enough times, you start to just recognize probability. It's a probable move, and you throw that belief of absolute out the window. You just don't believe in absolutes as far as the market's concerned anymore. And that's where you got to get your mind to. If you're still, if you're searching Google for the guru, that the trading system that's going to allow you to never be wrong, the software program, the AI program that's going to never be wrong in the market, well, good luck. You're going to spend a lot of money and waste a lot of time. That's one of the first things I would teach in a first lesson when I was doing a lot of coaching was, the sooner you can throw the belief out of perfectly predicting what the market's going to do or know what the market's going to do, the faster you're going to get your mind to focusing on the probabilities, which is where it needs to be. So all that inside week is signaling is a high probability for a pullback here. And then now, and we're, because we know it's not absolute, we're outlining where we know we'd be wrong. If we do break above the top of that candle right there, now, again, I don't like to even trade above that, okay? In fact, if we trade above that, I kind of lose a lot of confidence in that bearish reversal. But this is another thing with a lot of this stuff is there are gray areas, and sometimes you can trade a little bit above it and then come back below it. The problem here is that if we go up tomorrow and go up above it tomorrow, that's the end of the week as well. And so you're going to have a weekly close above. It's going to close above that. And now, if it did it early in the week, because that happened back here, remember that last bearish inside week I was kind of pointing to. The next week it actually traded above the candle during the week, but came right back down and closed actually lower than where it opened. So early in the week it tried to rally right back up and then faded all the way back down, and then we got the drop the next week. The problem, like I said, is we're not going to be able to get that here. We could if it does it today. If it rallies up above it today and then fades tomorrow back below, then you could get a close still within that range. But I don't even like to see it get up there. So am I a little nervous that I've got some bearish trades going on right now. So yeah, I'm a little nervous that it's that close to it. But again, that could change very quickly. If we sell off tomorrow in any way, that would quickly move this candle into more of an indecision candle. And actually the Qs have really, they tried to rally strong earlier yesterday, and then they faded really quickly into an indecision candle. We're still within that range. And, there could be a little bit of seasonality and baked into this as well. There's two things to be aware of. This Friday is not only the end of June, it's also the end of the quarter. Markets don't like to sell off big right before the end of the quarter because you have all these fund managers. What happens is at the end of the quarter, those results now they go and send out to their clients. So their clients get all these quarterly reports. And if you've got a retirement fund with a fund manager, you know what I'm talking about. You get those quarterly reports. They tell you how the performance has been going. And the last thing they want to do is have their performance, go from up 10% for the quarter to down or to up only 5% because there's a big sell-off the week before the end of the quarter, So unless there's a reason to sell, a big reason to sell, a headline reason to sell, sometimes you see the market kind of hold up a little bit ahead of that. Now, I'm just talking about the market in general, the indexes. It doesn't mean you can't have individual stocks that plummet or drop or rally, and so I'm not suggesting you can't make any trades around those, any bearish trades around those periods, but you just need to be aware of that. And just like anything that's kind of seasonality or typical, the only time you really want to use that is if it confirms what the chart or price action is already showing you. So if the price action looks bullish and you're heading into the end of the quarter, that's a confirming factor that the market could continue to go up. Or 4th of July is next week. The 4th of July week tends to be a more bullish week. Um, but I've gone back and studied this before, and on all those weeks where the 4th of July has been up, the market has gone up that week. Um, Sometimes it's just barely up, and so it's like, well, you can have a period, you can find a period almost any time of the year where every year it barely goes up, but you're saying, well, the last 20 years on March 3rd through 7th, it's always been up. Yeah, I'm really wary of those types of things, especially if it's these real small moves that are taking place, because you can find these pockets everywhere in the market, and they're just not very reliable. But I studied this, and I found that the reason why the market almost always went up in China is that the chart was always bullish at that time. And when I went back several years, I said, because I was really curious about, okay, when hasn't it worked? Because obviously it's not going to work every single time. And on the weeks where the 4th of July week was down, the chart looked bearish before that week. And so that's why I say never base your trade exclusively on seasonality, based on the chart. And if the seasonality confirms it, great. But if it doesn't, then you're probably in a situation where there's a lot of participants out there that aren't seeing it or aren't expecting it, and you can get a sneaky sell-off because everyone's thinking the market has to go up, or it's guaranteed to go up, or something like that. You get into this a lot of times with the Santa Claus rally in December, partly because nobody identifies exactly what a Santa Claus rally is. When is a Santa Claus rally? Don't get me started on this. I could spend the next hour ranting about this, but it's anywhere from Thanksgiving to the end of the year, and people pick and choose. Well, it's the week between Christmas and New Year's. No. It's the week right before Christmas. No, it's a period. It's a 2-week period right after Thanksgiving to right before Christmas. It's ridiculous. And yet it comes up every year, and people give that as the reason why the market's going to go up or go down, and it makes you want to pull my hair out. So I'm not going to continue that rant, because it's a waste of time. And you can go back to probably any market update I did in any December, and you can probably hear me, because I'll probably rant about it all December long. Every time I hear it, I just start pulling my hair out. But anyway, going back to what I was saying earlier, those are things to be aware of that could be what's holding the market up a little bit. Market might just be pausing to maybe get through the end of the quarter, and then maybe we sell off next week. Next week is kind of a unique week, because Monday's a half day, we're off Tuesday, and then you're basically trading Wednesday, Thursday, Friday. And so anyway, that and maybe we see it push off, maybe we see it sideways like this, or compact or indecisive until after the 4th of July week is done too, and we maybe see a drop in July, later, or that second week in July. Again, I'm not. That's the tough part about trying to predict when a move will take place. You just never know. But we do want to be aware of these, at least for the next this week and next week. These green and red lines. Above or below. Once we move up above or below was bearish. It means that that inside week is working. Above would be shaking that off. It just misses it. And then this no longer, if we move above this green line, it means that this no longer is significant. It's wiped out that move. Now it doesn't, as you can see, it still means that the market is overbought. So I don't know, and you've got this resistance, especially here on the Qs, you got this resistance area just above here. You'd be bumping right back into that again. You'll probably start seeing bearish reversal candles show up again at that point. So keep an eye on this now. Oh, let me go back, because there are, obviously the Qs are showing the greatest weakness on the weekly chart here. The SPYs are probably next. They're still within that range. But look at the Dow. Now, these didn't have inside weeks. These actually just had bearish reversal candles. But the Dow is trying to claw back and reverse that. What we'd be looking at here is the reason why this is a bearish reversal candle is because it closed below the low of the previous week. During this whole rally, we didn't close below the low of the previous week until last week. So there's usually a probability that you're going to start working your way back down. Now, it could just be that we work our way back down to here and then you break out. So again, I'm not suggesting that there's a massive sell-off coming. Notice how you're not as far away from that 200-week moving average as the Qs are. So maybe what you start seeing is the Dow having stronger rally days and shorter pullback days than the Qs. The Qs might have bigger sell-off days and shorter rally days. But that's something to keep an eye on. And then look at the Russell. The Russell's trading above that bearish reversal candle. Now, again, could it fade? At this point, we'd say it's going to close above the high of the previous week, which would be shifting more bullish. But tomorrow, if it fades tomorrow, it fades back into that range again. That's again where that gray area is. Is that a bullish confirmation there? Now, a lot of the Russell's up. Anytime the Russell is really outperforming, remember the two biggest sectors in there are oil stocks and financial stocks. So you're usually assuming. Well, I'm only assuming it when it's a mixed market. So the Qs are down today, but the Russell's up almost 2%. So that tells me immediately that there has to be outperformance by either the banks or the oil companies or both, because otherwise you'd see if they were moving about the same, moving in the same direction, it means it's more of a broad-based rally within the Russell 2000. But if you remember yesterday at the market close, they had the results of the bank stress test that came out, and so a lot of the bank stocks are up today, and that could be a reason for that. Now, pay attention to it, because if it does close above there, maybe it means that the bank stocks and oil stocks could start to rally, and but that would be a little bit more of a bullish argument to make. Right there is the Russell up 2% today, or up almost 2%. Oh, actually, it faded a little bit right there. Up over 1% at least, we can say. All right. Maybe I was looking at the VIX right below it there. All right, so let's flip back over to our charts here. And again, what I'm expecting here in this context with that inside week is that I'm assuming this is just wave A. Notice kind of the sluggishness. It's rallied, but notice the sluggishness of it. It had a pretty good up day on Tuesday. Then we opened lower yesterday and barely got back up to the close of Tuesday. Today we opened a little bit lower. We're barely at the high of yesterday, and we'll see if that fades a little bit in the close. But this is what a wave B typically looks like. It's a rally, but it's a sluggish rally. Now, I've had plenty of these where it looks like it's acting like a wave B, and then suddenly it takes off, and nothing can tell you exactly what's going to happen next. But from a probability standpoint, that's textbook wave B type rally right there. So I'm assuming this is wave A, wave B, and then we're going to get wave C. And I kind of think wave C needs to come back into this breakout area right here. So maybe down into here. Now, I also talked about, I think I talked about this on Tuesday, sometimes that wave B can develop a little bit longer, over a little bit longer period of time, meaning that could be wave A, this could be wave A of B, and then you get a little bit of a drop for B of B, and then you get wave C of B. Notice again, that would still be sideways, kind of choppy behavior, just extended out a little bit further, and then you get the drop. And actually that might make a little bit more sense in the context of seasonality, where maybe we just bounce back and forth over the next week and a half. Get next week out of the way. So maybe we drop tomorrow and a little bit. We drop a little bit on Monday, and then we rally the end of the week. There's your rally. There's your 4th of July rally right there. But it could just be that wave C of B, and then you get that move down. So again, what I'm doing here is I'm not trying to predict what I think the market's going to do. I'm just trying to game plan like you would in a football game, where you're trying to see. I'm trying to see if I can read what play the offense is going to run. Is it going to be a running play or a pass play? How are they lined up? After studying the tape of their previous games, when they line up in this formation, they usually throw the ball. Those are the types of things I'm doing when I'm doing this kind of analysis. Is I'm just trying to be prepared to where if over the next couple of days we drop, but not sharply, then it makes this more likely that you're still kind of chopping around in that wave B. It's behaving kind of like that corrective type pattern, and as long as it's behaving that way, you assume it's playing that out until it doesn't, until it's not acting that way. And I do this because it helps me. It's easier for me then to know when I'm wrong, because it's like, okay, this was acting like a wave B, right? Sluggish. And then you get a big up day like this all the way back up to the previous high. Okay. Now, none of that scenario is in play anymore. This is not a corrective wave B. This thing is taken off. And it's easier for me to not dig into my other analysis or outlook. Again, I'm not trying to be right. I'm not trying to be psychic or whatever. I just want to get the move right. And as soon as it suddenly is not acting like a wave B, I want to be able to flip the switch and say, boy, this thing could be starting to take off again. I better jump on board. Or I better jump on board for a real quick period of time, because it's probably going to get overbought in the next 2 days if it keeps rallying. Let's try to capture a 2-day move there and then see if we get bearish reversal candles or something like that. Again, that's the game plan. We just game planned looking at that weekly chart. We saw that there was a resistance area on the Qs. This is the SPY, but remember on the Qs, there's that other big resistance area up a little bit further. I've noted that. I'm aware of that. So I know, boy, breakout, it might only move for a couple of days, and this is where I would expect to see some bearish reversal candles. Now I can factor all that analysis into my decision making. If I'm going to trade it, I might choose not to trade it. It's too short of a move. I better just wait, or I'm going to trade it, but it's just going to be get in, get out, an overnight trade or something like that. Maybe an option trade where I can get a little bit higher percentage return off of a short-term move. And again, this is the purpose of my ramblings each week, going through all this stuff. That some of it may be repetitive, but it's just, I'm just trying to teach you how to game plan, how to be aware, and then how to make decisions based off of what ultimately ends up happening. And more importantly, to be able to recognize when you're right, when it's confirming what you were analyzing, and when it was wrong. When you're, the sooner you can recognize you're wrong, and that's always better. It limits the damage. All right. Let's go. We already analyzed all these. Russell, we pointed, was up pretty strongly today. Let me flip over to the VIX. So we've got the S&P is up, not a lot. We're only up 0.2% right here. And again, you've always got to compare the VIX to the S&P. If you're comparing it to the Qs or the Russell, it's not the right. It's an apples to oranges comparison. We want apples to apples or oranges to oranges. So always make sure you're comparing that. But What do I always tell you? The VIX doesn't always tell you something significant every day. If you think it is, then you're probably overusing it or overanalyzing it. But one of the key things you always want to make sure you're following on the VIX is when the VIX and the S&P are moving in the same direction, pay attention. And so we are seeing that today. We got a little bit of a bullish inside candle right here. We had that happen last Friday, and then Monday we got that sell-off that popped the VIX up a little bit. Again, it's not dramatic, so it's not like they were both up big, but it's telling me there's a little bit of hedging going on, and it could be end of quarter type behavior. And so that could be going on. But that just, we want to make note of that typically when you see what it tells me when the VIX is up and the market is up, it's telling me that there could be some buying going on still out there, but it's the professional traders aren't trusting the rally as much, and so they're buying some protection as they're buying stocks. Now, again, that doesn't always lead to a sell-off. But it does it just tells me that there's a little bit of a shift in the trust of the move. And usually you see this when the market starts to get a little bit overbought. It's a little bit harder for those traders to pull the trigger and buy at these levels. Again, especially since when they base their trades a lot on valuations, we don't look at valuations. We figure that's already factored into the chart, but it gets harder for them to buy. But when you're in chase mode, they still want to buy. But remember, protection is really cheap right now. Options are really cheap with the VIX down this low, and so they're feeling more comfortable buying by being able to buy a few protective puts as well. But they're not loading up on protective puts. And by the way, all I'm looking for here, if you want to know where I'll be more bullish as it relates to the VIX, we've already talked about getting that wave B complete and then get wave C, the market pulling back. And on that wave C, I'd like to see the VIX get up there close to 20. Because when you're in you saw this happen back here when we're in those long bull markets. The last time we were down this low in the VIX, that's a whole other story. This is why this doesn't make sense being down this low with this type of market condition over the last 6 months. But you can see right back here in 2017 and 2018, this is before COVID, we were in a long extended bull market. And what would happen is every time, the market kind of stair steps on its way up, right? Every time you get these little pullbacks, the VIX would spike up into this area up here around, in this case, about 15, 16. And then there were the lows down here that was even below 10. We were down around 8. I mean, but again, this is what you would expect at the end of a bull market. But you get these spikes in the VIX on the sell-offs up into this area here. And then this is where you wanted to buy the dip, because usually it marked the end of the pullback. That's another thing about reading the VIX. There's a lot of relativity in the VIX. There are times where and that's why I look at ranges. Back here we weren't even focused on 20 or 30 on the VIX because there was no reason to be. The market was in a strong uptrend. There was nothing that you could see that was really looking to derail that in any way. But it would fluctuate within this range. This is where you would look to buy when the pullback spiked the VIX up to here. This is when you would look to sell when the VIX got down to these lower levels. And so if this is a new bull market, then we should start to see that type of behavior. And we are seeing the VIX kind of flatten out a little bit here. But we should see it probably spike up, and maybe it doesn't spike up to 20. I still think it could spike up to 20 just because of how overbought it is, and that we're not in a long-term bull market. It hasn't earned this market trend hasn't earned the complacency yet. It hasn't earned that right to be the VIX to be down this low. But again, you get that spike up into here. Now you get the pullback in the market, and you get the sentiment that's alleviated a little bit. It's not as complacent as it is down here. And then you look for bullish reversal candles right here. So again, I got comments on this, and usually it's people who are just starting and they've been following me for 3 or 4 weeks, or maybe even a month or so, a couple months. You're always bearish. Every time you come on, you're talking about the market going down. You're always bearish. There is an opposite side to it, but again, it's got to be the market behaving bullish or in a bullish condition, or with patterns that I know work and that I can trade. That's why I can't trade parabolic moves, and they keep going higher, and people get mad when they keep going higher, and they get mad if I'm not, say, jump in and chase it. I'm disciplined not to chase parabolic moves. I'm willing to let them to miss it because I know another one's going to come around. I'll get one of them, but usually I might miss that first move, and then it'll pull back, and then we'll capture the next move. And that's the thing. If the market pulls back and a nice ABC alleviates that overbought condition, man, we could get pretty aggressive at that point, and I'll turn probably pretty bullish if there's a lot of those ABC patterns. There's a lot of charts out there. I'm going to go over a few of them here in a second they're looking pretty good. All right, so be aware that of that VIX move. If it closes this way, now again, and the VIX has a real tendency to make big moves in that last hour. It could come right back down, even go lower by the end of the trading day today. But if it holds this, it wouldn't be surprising if we get a little bit of a sell-off tomorrow. Probably not a big one ahead of that quarter, end of the quarter, but that would be something to kind of expect if that holds. I don't want to go through all the other, nothing really to comment on. Well, I don't know. Bonds made a pretty big move down. We were talking about this on Tuesday, that this looked like a bearish corrective type move. And we're bumping up against that resistance here, so that's not surprising, but we're still in that longer sideways range. Gold is showing a little bit of a bullish reversal. Now it's in that extreme oversold condition. All I'm expecting on gold, though, is maybe just a bounce or a correction. Maybe it just has a ABC back up until it shows me, if it really starts having a sharp move up, then it could look like a bullish reversal, but too early for that. I don't see it yet. But that candle could show you a short-term bounce or rally. I trade those a lot of times. If it holds it was looking like a bullish hammer yesterday and then faded into an indecision candle at the close. So that's interesting to note. Oil, it's rallying a little bit, but it's still kind of rallying within that sideways range. The dollar had a pretty big move up today. Now we were looking at this as being just a correction for a move down, but you got to pay attention to the fact that now we're retracing this move down quite a bit. If we go any higher, then you have to assume then that maybe this was the pullback and you're back into an uptrend on the dollar. It really would be the drop from here. From a probability standpoint, that's about as high as I would want a correction to go, as deep as I would want a correction to go before dropping. It keeps going higher. You have to assume that it's still trending up. All right, let's go. I wanted to go into the mega cap tech stocks real quick. I talked about NVIDIA. NVIDIA had that big drop on Monday, and then again, it's just kind of been sideways right here. This was the move down. This is moving sideways. What direction was it moving in before it moved sideways? It was moving down ahead of that. Now, it could just be this is A, B, and it has wave C. But this was a huge move up here, and it might need to correct a little bit more of that at some point. It doesn't have to be now, but this looks like it's rolling over a little bit. Again, not extreme, but it's just showing that at least from showing a little bit of exhaustion there, buying exhaustion. And again, why are we focused on these? We're not going to be focused on these much longer, but this is really what everyone talks about as being the reason why the market rallied. It's not the case over the last few weeks. It's been a more of a broad rally, but these stocks were the ones that were the main reason why the market rallied. They're so big. Microsoft and Apple are so freaking huge. I mean, they're basically they could be their own index on the market. They're so big. Their companies are so big. $1-trillion companies, multi-trillion-dollar companies. Apple's a $2 trillion company. I mean, it's insane. But they can be. It's hard because they're so big. It's hard to assume the market is going to rally significantly if these are selling off, or that it's going to pull back significantly if they continue to rally. Microsoft's shown a little bit of weakness here. Again, it had impulsive up, impulsive down. This has been kind of corrective. It's like it should have another move down at some point. Now, it could be that, again, this is wave A, and you get A, B, C for wave B. You get a little bit of a rally, and then you get a drop, and it creates kind of a inverse head and shoulders pattern or something like that. But it's sluggish right now, and we'll know that. Apple keeps crawling higher, though. I saw some weakness right here on this day, but it shook it off. Although, again, the candles are getting smaller, more compact, but it's not showing reversal. Well, it did that day, but it's not. Since then, it's not. It's still kind of grinding higher, and that's probably a key one because that is the biggest stock. AMD, again, showing more of a sideways move right here. We'll see if that leads to another move down. Google already been moving down. This kind of head and shoulders pattern right through here. Now it's also rallying a little bit. Could this be a correction for another move up? That's something to keep an eye on. Amazon, again, it's holding up, but again, look at that. All these bearish reversal candles. And it looks to me like the fingers on the edge of the cliff, they're trying to hold on before it gets tired and falls, you know. Tesla, I think this is wave A, wave B. I mean, use a wave C back down, maybe into this breakout area. Netflix, kind of the same thing. Looks like it's getting ready. So again, we talked about this in the whole market. You got the whole market looks like it's maybe completing wave B and could have a wave C, and you got a lot of these charts looking the same way. This is where I get confidence in my probabilities is when the indexes are showing a probable move, and then a lot of individual stocks are showing the same thing. Well, and that's what we saw. We saw that bearish inside week last week, and there was a whole bunch of bearish reversal candles on individual stocks as well. Meta is finally showing. Now, Meta is interesting because Meta it is rallying right up to where it started the gap down. This is where they were spending all that money on the metaverse, and they weren't making any money off it. They were just throwing money away. I wish some days they could throw money my way if they're going to throw it away like that. I'll take a couple mil. I'm not greedy. But it gapped down to this area here, bottomed out here, and it's been on this tear, but it's right back up into this area right here. And what can happen on this is there's a bunch of people that got burned on that. Yeah, actually it rallied off of that. The gap actually went from here down to here. It was actually worse, but there was the low. The bottom line is you had all these people that bought in right here, and it started a rally, and then they got burned because it just gapped down. They never had a chance to get out, and you get a group of people that are just holding on. It's eventually going to go back up. It's eventually going to go back up, and then it starts to go back up. And when it gets back up in this area here, if it starts to roll over at all, sell off again, they're back to break even. And if it can't break out above where they got in, it starts to drop again. That they don't want to go through this whole thing again. So there tends to be selling pressure. They start selling, and then you got short sellers that are seeing this. If it sees it roll over right here, they start shorting the stock, and that creates selling pressure. Now, if it can break above that, the opposite happens. It gets the buyers excited. But I just want to point that out, that Meta's in a very critical spot right there. And then notice the behavior, had a bearish engulfing candle right here, a couple of weak candles today. It could be a close below the low of the previous day. Just kind of starting to look like it's maybe flattening out a little bit. Again, none of these are real strong, at least with the exception of maybe a couple of these patterns. But you're starting to see a little bit of that weakness. And I'm more than anything, I'm pointing it out so you start to learn how to read some of the stuff. All right, let's get into some individual stocks. Now, again, keep in mind that we think we could still have that wave C. There are a couple of these charts that look the same way. And so when you're considering these, if you're looking to get in right now on them, then I can show you ways that in case you do have a wave C and these stocks have their own wave C, that you can still kind of stay in the trade. Me personally, I'd like to see that wave C first in the market, and then maybe put some of these stocks in a watch list and come back to them later. But let's go to the new buys. All the trades or stocks are coming from this list today because I found a bunch of them. This GRBK, again, there's kind of that textbook ABC pattern right there. It went higher. This could be a little bit of an ABC. And again, it's finding a little bit of support at the breakout area. Now, it didn't move very far out of that breakout area, so that concerns you a little bit that maybe this is the momentum is slowing down a little bit. But you could do a real low risk trade right here, put a tight stop, and if it keeps going higher, great. If not, you didn't lose very much. Let's just go to the list here. EXPI. That one right here. EXPI. This looks like it's coming out of an ABC pattern right here. And that's what you like to see out of the ABC patterns, impulsive move up. You also had it with that ABC pattern pull back to that breakout. So you got your cup formation right here. It broke out, it pulled back to it. Now, a lot of times it'll come up here and then go side, it'll correct right here. And that's what creates a cup with handle pattern. But this is a variation of the cup with handle pattern. Sometimes the momentum will break it out, but then it comes back and retests the breakout. That's great, because you can still take the top of the bowl to the bottom of the bowl and project that upward as a target area. And that's why this one still looks good. Now, you could, if you're a little bit worried about the market still having a wave C, you could wait until it breaks out above here in case it pulls back over the next couple of days. Or you could not care if it pulls back and just put a stop down below here. This is where you know you're wrong, because if it came back down, not only be below the ABC pattern, but below the breakout. That's how you can kind of manage that situation. That's a nice pattern. Another one is MOMO, M-O-M-O. Now, this is kind of one of my favorite bottoming patterns, when it looks like you're going up the right side of the bowl. So you see how it looks like we're going up the right side of the bowl. Another thing you want to confirm with this pattern was you had lower highs and lower lows on the way down, and now you're getting a higher low, higher high, higher low, higher high. Now, this is acting like it's getting ready for a wave C. and this is one of those I told you you could wait for the wave C, or I can show you how to kind of manage that. This looks like wave A. Notice how this is kind of sluggish on the way up. It's acting like a wave B, and then you should get wave C. Now, wave C is going to usually be about the same length as wave A. So we know if that's a wave A, that wave C will probably pull back into this area here. Now, you could wait for that to happen and then wait until it starts to move back up to make sure that's another higher low right there. So I could put this in a watch list and just feel like the market's going to pull back, wait, put this in a watch list and wait for it. If I'd been sitting through class cursing Jerry because you're extremely bullish and you hate hearing him talking bearish, and you want something to get into right now, because the market's not going to pull back. Okay, then you could get in right now and then maybe put a stop down below this low right here, because that was a higher low. If you suddenly go to a lower low out of this pattern, you're probably wrong. That you're probably not on the right side of that bull. Now your risk is a little bit higher there, wider there, but again, you're bullish. What do you care? Your market's going to go straight up from here, so that's where you would know you're ultimately wrong, would be at that spot right there. So those are a couple ways you could manage something like that. Another one I like is SoFi Technologies here, 95 strength rank. Same thing. It looks like, I mean, you can make the argument that this was ABC, but it didn't. It still is pretty overbought. This was a pretty parabolic move. And so and again, that's a bearish candle right there. So I'm looking at this as A, B, C. Again, that's what I told you earlier. The indexes look like they could have a wave C down, and you see a lot of these individual stocks look like they could have that wave C down. Why did I stop right here? Because that would be about where wave C would be, about the same length as wave A. You'd have a little bit of a resistance area right here that you could maybe line up with that, or right in here you could line up with that. Now, if you think it's going to go straight up from here, there's really no reason to take on more risk than this low right here. Or you could have the mindset of, I think it's going to go up from here. I'll put my tight stop right here. If it does have that wave C, I'll get stopped out. But then I could wait till that wave C completes and starts to move up, and then I can get back in with a little bit of confirmation, and then put my stop down below here. The danger in that, though, is that this may not work, and then you get stopped out twice. Putting a stop all the way down here, that's a really wide stop. I mean, that's 50% of the stock value right there. I wouldn't want to have that wide of a stop. And at that point, I'd just say I'm not even going to use a stop. It's an $8 stock. I'm willing to risk the entire $8. That's not necessarily a bad thing with some of these single-digit stocks. Because think of it. I mean, if you were buying a $90 stock and you're going to stop out at 82, you're willing to lose $8, right? Maybe you're like, you know what, I'm willing to lose $8 on this. Let's not even have a stop. You could manage it that way. You just wouldn't want to have, a large percentage of your portfolio in that one stock, though, without a stop loss. All right, so there's that one. And then I liked this one here. Encore Wire Corp, WIRE, 94 strength rank. I really like this pattern. Again, you got kind of the bull. It looks like you're moving up the right side of the bull. You have lower highs, lower lows. Again, look at that bearish ABC pattern right there. Textbook, impulsive down, corrective, impulsive, corrective, impulsive down, impulsive up, corrective. I mean, this is textbook. I mean, exactly how I teach you as far as the trend behavior, produced a higher low with, you had impulsive up out of this, a higher high. This looks corrective right here, higher low. This looks impulsive up through here. So I like this so much, I'm going to put this in the portfolio, and I don't want to risk a ton, so I'm going to put a stop. Actually, no, I'm going to put a stop down below here. Let's see what that looks like, because this is where I really know I'm wrong. And that way, this could be wave A, wave B, wave C, or something like that. We get a wave C down. It shouldn't go below here. And so that would be, let's look at these lows right here. The low of that day was 159. So let's add this to the portfolio. I don't know why it does this. It's like when I've been teaching for a little while, it just kind of freezes on me here. Maybe it might be something to do with the go to webinar software. Let's try this again. All right. Stock specific stop price at 159. I can't do 100 shares. That'd be 18,000. So we're looking at about 50 shares, be about 9,000 in the trade. Again, you got to pay attention to this. I'm willing to risk this because it's, I want my portfolio percentage risk to be under around 1%, but at least under 1.5%. This is under 1%, but the dollar amount is 1,300. You got to be able to accept that. If that's too much, because we get stopped out, that's what we're going to lose. And if that's too much, then it means you buy fewer shares, or you maybe have a higher stop. But I'm okay with this one, so I'm going to go ahead and purchase those. Now, real quickly here, I know because we're running out of time, I did get stopped out today on, and I got out this morning on ADMA. Now, usually I'll wait till the end of the day, but this was such a sharp move. And I actually wanted to be out of this because I didn't like how it just looked like it was going to end up stopping me out. My stop was down below these lows right here. And so I got out as soon as I actually put an order in to stop out at my stop price because it opened a little bit above my stop price. And I just said, if it drops down there, I just want to get out right at my stop price. So I'm out of that one, which is why I feel fine adding another one in that looks better. I don't think if there's anything else I did. You can take a look at these real quick. HTML, this is another one that this is the last ditch hope here. I mean, I almost got stopped out here, but we got a little bit of life here. Those are two bullish looking candles. But again, out of this move right here, this is now a pretty deep retracement of that move, and it's kind of getting this look of rolling over. I'm at the point now where if this now suddenly reverses, we get a couple big down days, I may just go stop out of that thing on my own without waiting for it to get to my stop, just because it'd be, if it drops from here now, it would be a lower high. We already kind of went to a lower low right here, so that would not be looking good. The SQs are just my hedge. I'm still going to hold that in there because I think that that bearish inside week on the Qs, I think we're still going to get a move down, and if it does, I want to be able to make a little bit of money on that and hedge against any pullbacks on some of my other positions. It's not a big hedge, so it's not going to do a ton. but I'm going to keep that in play. Riot still looks fine. I got my stop down below here, down below this low, I think. This is kind of that Bitcoin play. MTW's done pretty well since we got in. We got in this one on Tuesday. I like this kind of bull pattern right there. And that's why I like the pattern. You see a lot of moves like this off of those patterns. And then the new one here. All right. There was, I wanted to point out a couple more here real quick. This SRAD have down a 2-year chart. Oh, yeah, that's why I put it. So this looks like it's coming up to a real, this one needs confirmation, but look at this. Look at this triangle formation right here. It's perfectly held the support of that. There's pressure building into the corner. If this thing breaks out, now the rule of thumb on a triangle formation like this is you can, if it breaks out, you wait for the breakout, you take the base of the triangle, which is basically this move right here, and project that from the breakout. That puts it up around $19 to $20, somewhere in that range there. So that one you might want to put in the watch list. And then this one, it was an interesting one just because if you remember the old days of BlackBerry, now BlackBerry is no longer a phone company, they're a cybersecurity company. I noticed this whole pattern. Now the strength rank on this is pretty low, so just be aware of that. I like the pattern here. It's lower highs, lower lows. And it's kind of had now it had a higher low, even high, higher low, higher high, higher low, and it's up pretty decent amount today. And I went and looked at, I just got curious because I remember this when it used to be Research in Motion back in, and this was the Apple for phones before the iPhone came out. But I went and looked at, and I'm not a fundamental person, okay, but I was just curious as I just started to dig it, because again, curiosity is following this company for a while. Not following it for a long period of time. It's been off my radar for a long time. But I noticed that, the last few earnings reports, here was one where they were reporting a loss still, low revenue. Last earnings report, still reporting a loss, and they actually had smaller revenue. And then this report, just recently here, they finally turned a profit, albeit a small one. They were expecting a small loss. They turned a small profit, and then huge revenue growth, 364 million when they were averaging like 100. They doubled their revenue. So if you're a fundamental trader and you like to compare charts with the fundamentals, man, that would be a good combination right there as far as taking a chance on something. It's acting like an uptrend right here. It's showing the fundamental story. Looks like it's turning around. So anyway, I thought I'd throw that in there as a little bit of a bonus here at the end of class. All right, that's it. Remember again, if you join late, that the market is only a half day on Monday. What closes at 1 p.m. Eastern time. Tuesday is a holiday. We will not have a market update class Tuesday. Stock specific class will be next Thursday, and that's it. Have a great and safe, happy holiday weekend. Hopefully, you're taking a few extra days off during that time. Hopefully, you get Monday off, and you can just kind of enjoy the summer weather out there. All right. Thanks, everyone. See you next week. Bye now.